Hello friends, good evening to all of you. And today in this video, we are going to start with another chapter from the accounting and financial management for the bankers. And this video series is going to be in English. But wait, we are having the courses in both the languages, that is Hindi mix English language as well as in English only language. So if you're preparing for bilingual course also, you can get the course from our website, or you can simply be getting all the PDFs. You just need to save the number that is written over here 83609 and after saving the number just WhatsApp on the same number writing saved for JAIIB and we will be adding you to the update list. So let's start the session, and in today's session we are going to start with the topic of the foreign exchange arithmetic, which is certainly a very important topic from the exam point of view. So what is foreign exchange? So let's say case I'm having 100 INR with me, Indian rupee with me, and I want to get the USD. How many USDs I'll be getting? Let's take the case that one USD is equal to 76.40 INR. What does it indicate? That one per USD is available for 76.40 rupee. And further, this is the exchange rate, right? And foreign exchange market is very much dynamic and very much wide, very much volatile, working 24 by 7, and this is very humongous market, right? So foreign exchange means all the deposits which are actually payable in the foreign currency, whether it is in the form of a draft, letter of credit, bill of exchange, or traveler check, or anything which is actually payable in the foreign currency. Or it could also be anything, traveler check, letter of credit, bill of exchange, expressed or drawn by the banks or institution outside India and payable in Indian currency. Then also it means the same case that it is foreign currency or foreign exchange. And the foreign exchange actually do denote the price or the ratio at which we can exchange one currency with the another. I just gave you the one example over there, right? So as I told you, this is a very dynamic rate, the very dynamic market. It changes from day to day, minute to minute, second to second, and it actually depends upon variety of the factors, and a huge number of stakeholders do participate in this particular market, whether those are the supervisors, whether those are the central banks, whether those are the businesses, individuals, everyone do participate in the same. And this is a communication based system, and in banks or financial institution there is a particular department which deals with the foreign exchange markets, and that department is said to be what? Do let me know in the comment section. Do let me know in the comment section. It is having three major components. That particular department is having the three major components. That is a hint. It is having the front office, it is having the back office, and the mid office, right? You know, in the comment section, and if you answer it right, you'll be having a chance so as to win the free AFM pack, complete pack for free of cost, right? Now the markets do operate in the different time zones. See, whensoever we are talking about any opportunity of earning, definitely there can be a risk. Now in foreign exchange markets also, the different types of risks are there. It could be the operational risks of the systems, failures of the systems, natural calamities, frauds, etc. Right? It could be the fund is having a commitment. They are having a particular amount of use. Let's say person, there was a contract that person A will be selling 10,000, person B will be buying 10,000 USDs, right? But in the Nostro account, I'll be just letting you know each and every time, right? Do not worry. So let's say in the Nostro account of the person A, the sum balance is, the person is short of 1500 USDs. Now in that scenario, the person A is to buy the USD from the market, which the person A may not be able to procure at a reasonable price, right? It will be losing. So there is some network issue right now. Okay, I feel that it is working fine now. I'll be just repeating the thing. So previously, if we talk about the Indian forex market, previously the prices were fixed by the Reserve Bank of India. There was no liberalization, right? And there was a upper band and the floor price which were being fixed by the Reserve Bank of India. But before that, let me just tell you about the two-way quotation. If we talk about today's era, the prices are being, those are being maintained due to the demand and supply forces, right? That is the scenario. Now let's learn about the bid rate and the offer rate. But before that, let me just tell you about the two-way quotation. That what do you mean by the two-way quotation? Let's say case it is said that 1 USD is equal to 86.50 slash 70. Now in the same quote, there are two types of prices being given. Okay, one it is a buying rate and other one it's a selling rate. Okay, so when I'm telling about the buying rate, it is particularly that particular rate at which the bank is ready to buy, and when I'm telling about the selling rate, it is the rate at which the bank is ready to sell. Okay, so if I'm saying that the buying rate over here, so the rate on the left side is the buying rate and the rate on the right side is a selling rate. So over here, 86.50 is the buying rate and 86.70 is the selling rate. Is that right? Okay, so it's a two-way quotation. Why I am saying it's a two-way quotation? Because both the prices are given in the same quotation. Those are given in the same quotation over here, right? So bid rate is actually the bid rate is actually the rate at which the bank is ready to buy. That is said to be the bid rate, and the rate at which the bank is ready to sell, that is the bank is offering to sell, that is a offered rate. So those two prices are there. We also name it to be the buying rate to be the bid rate and selling rate to be the offered rate. So here the bid rate is 86.50 and the selling rate or the offered rate is 86.70, right? And after that, it is same thing that is written over here, that is related to the two-way quotation. That is the same quotation that you are having the buying rate as well as the selling rate is there, okay, at which the bank is ready to sell. Now, after that, this is related to the indirect court and the direct court. And this topic is definitely very much important. And nowadays, the direct court is only being used. Direct court is a court where the home currency is variable and the foreign currency is having a fixed unit. Let's case if I say 1 USD is equal to 87.50 INR. What does it indicate? That for 1 unit, how much INR I'll be getting. For 1 unit of USD, how much INR I'll be getting. So here the USD is a foreign currency and Indian rupee is a home currency. The home currency will be variable and the foreign currency will be having a fixed unit. That is a direct quote. So whensoever in the direct quote, we want to make a profit. So in the case of the direct quote, if we want to make a profit, it is rightly said over there. What's the case is there? In case of the direct quote, that buy low, sell high. The scenario is buy low, sell high if we want to make the profit in case of the direct quote, right? In case of the direct quote. So all the currencies are actually quoted as per the 1 unit of the foreign currency. Like we say 1 USD is equal to this, 1 euro is equal to this, 1 GBP is equal to this. But in the case of three currencies, that is Japanese yen, Kenyan shilling, and Indonesian rupiah. These are the three currencies where the currency quotes are given for 100 units of the foreign currency. Like we'll never be giving the quote for 1 JPY is equal to this. We'll be giving the quote like 100 JPY, 100 Japanese yen is equal to, let's say, 119.70 INR. That will be the quote. It will not be the quote which will be given for the single unit of the currency, but will be given for the 100 units of the currency. For Japanese yen, for Kenyan shilling, and as well as for the Indonesian rupiah, right? So on the other way, we are having the indirect quote. In case of the indirect quote, the home currency is having a fixed unit. Like we'll be saying for 100 INR, we'll be getting how much USDs. Let's case we say that we will be getting 1.32 USD. 1.32 USD. So this is what type of quote? This is indirect quote, where the home currency is fixed and the foreign currency is having a variable So there will be a variable position for the same. And these indirect costs are now not used. These costs are not used. And in the case of the indirect cost, if you want to make the profit, such type of questions are also asked, right? For the direct cost, if you want to basically make a profit, it is buy low, sell high. But for the indirect cost, if you want to earn the profit, it is set buy high and sell low. How this is true? Let's say case I got 1.31 USDs for 100 rupees. I got 1.31 USDs for 100 rupees, right? And further, I'll be selling when I'll be getting lesser USDs, then only I'll be making profit. Let's guess if we get only 1.20 later on, if we get only that 100 INR, we get only 1.20 USD. In that scenario, I'll be making a profit because it is a scenario of buy high and sell low. We purchased when we got the maximum value out of it, and we sold when we getting the least value out of it. Is that clear? Kindly please do confirm. Is this particular thing clear to you? Kindly do confirm this at the earliest. Are you able to get this particular point here? Yes or no? Kindly please do confirm. After that, it's a concept of the cross rate. Sometimes it may be the scenario that the direct cost for one particular currency to the other currency is not available. Let's take the scenario that we are having the 1 USD is equal to 87.50 INR, and also it is given 1 USD is equal to 1.06 euro, right? That is given, but there is no quote given for euro to INR. I want to get the quote for euro to INR. Now what we can do, as we did in the primary sections or in the early classes, LHS is equal to RHS. So we can equate these two things because both the sides are equal to 1 USD. So we can simply be rewriting it as what? 87.50 INR is equal to 1.06 euro. That is the scenario. And euro to INR would be equal to euro divided by the INR, that is equal to 87.50 divided by 1.06. Easy to solve, and we can easily be solving it. We can easily be solving it and we'll be getting our answer. Is that clear? So this is how the cross rate works. Further, we'll be solving the questions based upon it. So do not worry about the same. And if you want to get the PDF of this particular video, if you want to get the complete PDF, you just need to save this number. I've already conveyed the thing to you. That is A3609 44207. Just save this number in your mobile and WhatsApp on the same number, writing saved for JAIIB, and we'll be sharing all the details to you, right? After that, let's solve a question based upon it. Let's try to solve the question. So again, definitely these type of questions are very much important for the concept building, right? So it says B wants to remit the euro, right? B is a person, is a customer who wants to remit the euro. It may be an importer also, right, who wants to remit the euro, and the USD price is given and USD to euro price is given, and we need to get the euro to INR rate. Now it might seem easier, but wait, you are having two quotes. One, it's actually equal to 1 USD is equal to 76.10 slash 20 INR, right? That is the thing. So here we are having the two-way quotation. One of it is the buying rate or the bid rate, and the other one it is a selling rate or the offer rate, right? That is the scenario. And you're having the other quote also, which is 1 USD is equal to 1.06 euro. That is a quote which is available to you, right? This is a quote. This is a single quotation which is given to you. But now the problem is that how we are going to identify that we are to take the buying rate or the selling rate, right? Now that's the question. Now actually there are two types of rate. Kindly listen to it carefully. This is important. There are two types of rate. One, it is a interbank market rate. When the banks are to quote the prices to each other. So it's an intermarket rate or interbank market rate, right? And the other quote is merchant rate. When the banks are to quote the prices to the customers, it's a merchant rate, right? Now let me just write the things for you, which will make the questions very much easier to you. So for interbank market rate, buying rate is the buying rate and selling rate is the selling rate, right? So when the banks are dealing with each other, right? So when there is no reference related to the customers in the question, we'll be using the buying rate as the buying rate, selling rate as the selling rate, right? But when there is a reference given for the customer, right? For the customer, exporter, importer, or anything, in that scenario, the buying rate, the customer will be buying at the price at which the bank is ready to sell. The customer will be buying at a price at which the bank is ready to sell, and also the customer will be able to sell the foreign currency at a price at which the bank is ready to buy. So the prices do change accordingly, right? Now in this question which is given below, just pay attention. B wants to remit the euro. B is who? B is a customer. So what rates we are going to use? We'll be using the interbank market rate or the merchant rate. Kindly do let me know what rate we will be using. It will be the interbank market rate or the merchant rate. Definitely we are going to use a merchant rate. Now think it from a common man point of view, from the common point perspective. What is the perspective? Let's the case you want to remit the euro. You want to remit the euro, right? That is the scenario. For that scenario, you are having the INR with you. Let's say you are having the INR. So you need to basically buy the euros first of all. So customer wants to buy the euro, wants to buy the euro. So customer will be able to buy the euro at a price at which the bank is ready to sell. So what quote will be given by the bank? The bank will be giving a selling quote. Getting the point? So what quote will be given by the bank? So the selling quote will be given by the bank. So first of all, the customer will be buying the USDs because then only he will be able to exchange the USDs with the euros. That is a scenario. Okay. So here the customer will be buying the USD and will be able to buy the USD at a price at which the bank is ready to sell. So the selling cost for the USD is 1 USD is equal to 76.20 INR. This is a selling cost, right? So that would be the first scenario, and the second is already given to you. So this is the first statement and this is the second statement. Now we can equate it easily. So it is 1.06 euro is equal to 76.20 INR. So it will be euro to INR, that is 76.20 divided by 1.06. Now the simple calculator is actually allowed in the exam. Do not forget to take this calculator along with you, right? So it is 76.2 divided by 1.06, that is 71.886. Okay, is this particular thing clear to you? Kindly please do let me know at the earliest. Okay, so this is how you can be solving the questions. So question particularly in this question particularly we got to solve two or three concepts, right? What concepts we did learn? One, it's related to the two-way quotation, that how it works. The other, we learned about the cross rate, or we say it chain rule. The third one, it's related to the rate discovery, that it will be a merchant rate or interbank market rate, right? So definitely on this behalf, this video actually deserves a thumbs up. So do like this video at the earliest, right? So now let's proceed. The next concept, it's related to the value date. Okay. So it may be the case that you have already transacted a transaction. Kindly pay attention. It may be the case that you have already transacted the transaction, but it may be the case that it is not effective in the account for today, right? Let's say I just made a transaction, right? but the account statement was not reflecting that particular transaction. In that scenario, the value date is actually will be different from the settlement date. Settlement happens on some other day, right? The value date was something different, right? That is a scenario. So in the case when the value date and the settlement date is same in both the centers, that I transacted the transaction today and it got settled by today itself, it got settled by today itself, then it is a telegraphic transfer, or we simply say it is a TT transaction. So I made some transaction today. Let's say today it's the 1st April, and the transaction got settled today and also got reflected in the account of the other party by today itself. Then it will be what transaction? It is a telegraphic transaction. But if it is not reflecting in the books on the both centers on the same day, then it is bills transaction. Then it is a bills transaction. Getting it? Okay. So when it is telegraphic transaction, there is no gain or particular no loss related to the interest accrual, because there will be no accrual interest that will be paid because the transaction is actually reflecting on both the centers on the same day, right? That is the scenario. Now after that, it's the exchange rate mechanism. Again, it's a very important topic. Now there are different type of the rates which are applicable. For now, the examples so far, we have covered the rates. I told you about the cross rate. I told you about the two-way quotation and so on. So majorly whatsoever the transaction you will be looking around, those all are concluded at one particular rate, which is said to be the spot rate. Now, what is spot rate? I'll be discussing it with you. But before that, let's discuss about the ready rate or the cash rate. So when the settlement of the funds do take place on the same day, the settlement of the funds do take place on the same day. T, it means the time of transaction. Zero means no delay. Settlement is happening on the same day. Then the particular rate is set to be the ready rate, or we also say it to be the cash rate. We also say it to be the cash rate. Okay. So that is the ready rate or the cash rate. For example, we did a transaction on 1st of April and it got basically settled on the same day. Then the ready rate or cash rate will be applicable. But when there is a delay by one day, that we did the transaction today on 1st of April and it got settled in the accounts on the very next day on 2nd of April, then it will be what rate? It will be the term rate which will be applicable. It will be the term rate which will be applicable. But take a note of the same, that both the days must be working in both the centers, right? It may also be the scenario like let's say the transaction was there on 1st April and there was holiday on 2nd of April in one of the centers, and on third day the transaction concluded. There was no holiday on the third, and the third day the transaction concluded. Then also it will be the term rate. Why it will be the term rate? Because there was holiday for one of the days, right? In that scenario also it's a term rate. So it is very much mandatory that the days must be, both the days must be working in both the centers, right? So that will be the term rate. Okay. After that, it's the most voluminous transaction rate, that is a spot rate. Mostly whatsoever the transactions are there, those are concluded on the spot rate, right? So the volume, depth, volatility of the spot rate is very much higher because of the larger participation of the market players in the spot trades. So in the case of the spot rate transaction, the settlement does take place after 2 working days, or on the second working day the settlement does take place. Like let's say case the transaction was there done on 1st of April, will not be concluded on the second of the day, and will be concluded there on the 3rd of the April. That will be what? That will be the spot rate. But both the days, that is second and third, must be working days in both the centers, right? So that's a spot rate, right? After that, it's related to forward rate. See, the forward rate would be a particular rate if the settlement of the transaction is beyond the second working day. If the settlement is beyond the T plus 2 days basis, then what rate will be given? It will be the forward rate which will be applicable. Then in that scenario, it will be the forward rate which will be applicable, right? Let's say case that you did a transaction today, but it's going to settle on the next month after 1 month. So it will be the forward rate which will be applicable. And the forward rate is having actually two components. So the forward rate is having the two components. One, it's linked to a spot rate. So whenever we are discovering the forward rate, it is discovered on the basis of the spot rate, right? Plus minus forward points. Now, what are the forward points? Forward points are calculated based upon the interest rate differentials. Now, what is interest rate differential? Let's case there are two countries we are assuming, one it is India and other one it is the USA, right? And let's now assume the rate of interest in India is 9% and rate of interest in USA is 6%. Now the investors in USA, they will be selling, they will be starting selling the USDs, they will be selling the USDs so as to buy the INR, and they will be buying the INR and they will be investing into India because they are getting higher rate of interest. Is that clear? There is higher rate of interest in India, right? So the difference between the interest of the two countries is said to be the interest rate differential, and it's a major factor due to the forward particularly when we do calculate the forward rate now, it's a major factor. Other factors are related to the forward period. Let's guess if we are going to calculate the forward rate for 3 months, then 90 days will be there. If we are calculating for 1 month, then 30 days will be there, and this is also second factor. So the first factor it's related to, which is going to impact the forward points. So if we talk about the forward points, the factors which are going to impact, one it's related to the interest rate differential. Interest rate differential. The other one it's related to the forward points. And last but not the least, the third factor it's the spot rate. Okay, so these three factors are there. And whenever we do calculate the forward rate, it is spot rate plus minus the forward points. So if the currency is available at premium or at a dearer rate, let's say case today 1 USD is equal to 87 rupee, and after 1 month the USD is equal to 87.50 rupee. Definitely the currency is available at a premium after some particular point, right? So when the currency is available at premium, in that scenario the forward points are added to the spot rate. Okay, and if the currency is available at a discount, today the price is 87 and after 1 month the price is, let's say, 86.50, means the currency is available at discount. In that scenario the forward points are to be subtracted from the spot rate. That is the case. Okay, we'll also be solving the questions based upon the same. So it's actually equal to the forward points. I just told you forward points are dependent upon some factors. One of the factors it's related to the what? One of the factors it's actually related to the spot rate, other is forward period, and the third one it's related to the interest rate differential. So forward rate, as I told you, is spot rate plus premium or minus the discount, right? That is the case. So the value of the currency is more than being quoted for the spot rate, then the currency is said to be the premium, and in that scenario the forward points are added up. And if the value of the currency is more than being quoted for the spot rate, the currency is said to be the discount, right? In that scenario the forward points are subtracted. Okay, is that clear? Now let's solve this question. Let's just solve this question, you'll get the complete idea here. So we are having the spot euro. Spot rate for euro, 1 euro is equal to 1.3200/10. This is the buying rate, this is the selling rate. Okay, And also we are provided with 1 month forward, 2 month forward, and the 3 months forward. And we are to calculate the 1 month USD can be sold 1 month forward. So when we are to calculate 1 month USD sold point, selling point, we'll be writing the 1 month forward points. 1 month forward points are 40/35. These are the forward points. These are the buying forward points. These are the selling forward points. Getting it? Are you getting this particular point? Right? And we have to get the selling point. Now, as I told you about the interbank market rate or the merchant rate, is there any reference to any of the customers? No reference. No reference for the customers. Okay. So we'll be concluding the transaction as the interbank market rate. What rate will be concluding it at? It will be concluded at interbank market rate. Interbank market rate. Okay. So the buying rate is a buying rate, selling rate is a selling rate. So we were to calculate 1 month selling rate, right? So we'll be looking at the selling rate. So 1 euro is equal to 1.3210 USD, right? That is the scenario. And also we are given with the forward points here. Now listen carefully. Listen carefully. So in the scenario, if the selling forward points are greater than the buying forward points, I'm taking it as case number A. If the selling forward points are greater than the buying forward points, then we say the currency is available at premium. When the currency is available at premium, the forward points are added up. Second scenario, if the selling forward points are lesser than the buying forward points, we say the currency is available at discount. And at that particular point, we do subtract. We do subtract what? We do subtract the forward points, right? Now, in this scenario, selling forward points are lesser than the buying forward points, means the currency is available at discount. So we are to subtract the forward points, right? So 1 euro is equal to 1.3210 USD, right? And also the forward points are 35, right? So 35 are to be subtracted. These are to be subtracted. So the answer will be equal to what? It is 1.3175. That will be the answer. So 1 euro is equal to 1.3175. That will be the answer. Is that clear? How we basically solved it? So first of all, we will be writing the spot rate. We wrote the spot rate over here, and we were provided with the 1 month forward, 2 month forward, and 3 month forward. But we were to calculate the 1 month USD selling point. So we'll be looking for the 1 month forward points only. We just wrote it here. 1 month forward points. We just wrote it here, right? And I just told you the scenario. If the selling forward points are greater than the buying forward points, we say the currency is available at premium. If the selling forward points are lesser than the buying forward points, we say the currency is available at discount, right? And accordingly, we just saw that the selling forward points are lesser than the buying forward points over here. So we say that the currency is available at discount. The currency is available at discount. And when we say the currency is available at discount, we'll be subtracting the forward points. And that is what we did. We picked up the selling rate, that is 1.3210. This is the selling rate, right? And after that, we picked up the forward points for the selling rate, that is 35. And 35 is representing the last two decimal places only, right? So if we wrote it 0.0035, and then we subtracted the forward points, right? And we got our answer. Is that clear? Okay. Is that particular point clear to you? Now let's have a look at the other question also. Okay, so that will be the last question for today. And if you like this video, kindly please give this video a thumbs up, and do not forget to subscribe to this channel. So we are provided with the spot rate, that is 1 euro is equal to 1.3200 slash 10, and we are provided with 1 month forward, 2 month forward, and further 3 month forward. And we have to calculate the 1 month USD can be purchased at. We have to calculate the buying rate, right? And 1 month points are forward points are given to be 40 slash 35. The same question as previous one. So these are the buying rates forward points, these are selling forward points, right? And we are interested in what? We are interested in buying price, purchase rate, right? So we'll be considering 1 euro is equivalent to 1.3200. This is a buy rate. This is a buy spot rate. Buying spot rate, right? Now after that, the forward points for the buying are this one. So it is 0.0040. Now, just do let me know the currency is available at premium or discount. We'll be looking at the forward points. Forward points. And over here, selling forward points are lesser than that of the buying forward points. In that scenario, the currency is available at discount. And when the currency is available at discount, the forward points are to be subtracted. Now the forward points are 0.0040, so those are to be subtracted. So it will be 1.3160. So 1 euro is equal to 1.3160. This is how we'll be calculating the prices. Now your homework is that you are to calculate the 2 month forward selling price. Okay. You are to calculate. Let me write over here 2 month forward selling price, right? And you need to write the answer in the comment sections thereafter the class ends up, and then the winner of the particular question will be given the free AFM pack. Okay, so that will be all related to this video. I hope that you must have liked this video, so give this video a thumbs up. And my name is Ashish, and do subscribe to this channel. And if you want to get all the videos, all the PDF, just do save this number, that is 8360944207, and WhatsApp us on the same number writing saved for JAIIB. Our team will get back to you and will be answering all your queries, and definitely will be giving the links to you for all the PDFs for free of cost. Thank you so much, and see you again in the next video tomorrow. Happy learning.